Hey, this is Buck with Keller Williams Realty. Today we're going to talk about how much out-of-pocket cash do I actually need to buy a house. Most people aren't exactly sure when they're buying their first house how much money they're actually going to have to bring to the table. You know you're going to borrow most of it from the bank, but how much do I actually have to have in my own bank account right now, and how much am I going to have to pull out of the pocket? Well, there's basically four major things. The first one is your down payment. That's the biggest one. Generally speaking, the lowest down payment you're going to be able to do is 3.5%. That's on an FHA loan. FHA loans have a little bit more fees, so it would be advantageous if you could save up 5%. If you can do 5%, then you can go to a conventional loan, which has just a little bit less fees. The main difference being that an FHA loan has a 1.5% upfront fee that they tack on to the loan amount. So basically, if you're buying a $200,000 house, you're only going to need to bring in $7,000 for a down payment because you're bringing in 3.5%. But they're also going to put on a 1.5% fee that would be added to the loan amount that would not actually be the case in a conventional loan. So in a conventional loan, you'd have to bring in a little bit more up front, but they don't tack on that 1.5% fee. So basically, depending on what you can afford, either 3.5% or 5%. And in a future video, I will discuss some more differences between FHA and conventional. So, once you get your down payment ready, you're going to have to keep in mind that you have to have that money in the bank generally for 60 days before the purchase. The bank that you're borrowing your mortgage from, they actually want to see that you've got that money in your own account for 2 months. Basically, you can't just show up at the closing and say, well, I got this money yesterday. They want to see that you've had it sitting in your account for at least 60 days before the closing. So keep that in mind. If you're saving up, you're going to need that, off the bat a couple of months before the actual closing. So that's step one, your down payment. The second thing that you're going to need is an earnest money check. Your earnest money check is actually part of your down payment, but you put that check to the seller right off the bat when they accept the offer. That's usually 1% of the purchase price of the house. So if you're buying a $200,000 house and you're doing a 5% down payment, you're going to need $10,000 for the down payment, but you're going to need a $2,000 earnest money check that's written out to the seller's real estate company upon acceptance of the purchase agreement. That's what some people like to call a good faith deposit. Basically, it's money that you're putting in right off the bat so that the sellers aren't concerned you're just going to walk away and not show up at the closing. Because if you don't put that money in, then you've really got nothing into it. And if things change, well, maybe you don't show up that day. That earnest money check is something that the sellers could keep if you just bailed out on the loan. Not that that happens very often, but it could. So anyways, with your 5% down payment, you're going to need 1% of the purchase price of the house written out right off the bat. So that money you're going to have in your account right away when you find something that you like. Then the third thing would be the home inspection. The home inspection is generally around $300. It varies from inspector to inspector. As a matter of fact, you don't even have to pay an inspector. You could have a friend of yours be the inspector, or your dad, whatever the case may be. But it's highly recommended to get a professional home inspection. In a professional home inspection, an inspector is going to go through the whole house, look at all the different systems, and it's going to take them about 4 or 5 hours. And then based on that home inspection, you're going to decide whether or not you want to proceed with the offer or not. So that's about $300. Then the other major thing that you're going to need is the appraisal money. Most banks are going to want you to pay for the appraisal right off the bat, and that's around $400. Banks do have other closing costs associated with the loan, but most of those you can actually borrow and roll into the loan if you want. You have the option of either bringing them to the table or borrowing them and rolling them into the loan. Usually the closing costs are about 2.5% of the loan amount. So on a $200,000 house, the closing costs are going to be about $5,000 altogether. Now that's not entirely money that all goes to the bank for their fees. Some of it is money that you're going to put in an escrow account for your taxes and insurance. So, 4 things that you need. Your down payment money, and that part of that is broken into number 2, which is your earnest money check, which is 1% of the purchase price of the house. Then number 3, your home inspector fee, which is going to be around $300, and your appraisal fee, which is going to be around $400. If you have any more questions, call me, Buck Dahani of Keller Williams, at 612-803-2718, or go to www.southmplshomes.com. That's MPLS, the abbreviation for Minneapolis, southmplshomes.com. Thank you.